Welcome to Finance for Middle Managers, Cash Acceleration Made Simple. You know, in a sporting event, it's easy to tell the score. It's easy to tell who's winning. We just need to look at the scoreboard and say, does the home team have more points or does the visiting team have more points? And when the clock expires or the final inning is concluded, the team with the most points wins the game. Well, in business, it's not quite so simple. See, a key principle that I want you to take from today's webinar is the fact that revenue is vanity, profit is sanity, and cash is king. But think what gets the most attention when most people are talking about their business. It's revenue and revenue growth. And what I'm going to propose is that maybe our focus should be on profits and on cash. My objectives today in this webinar is for you to leave with an understanding of how to align operational initiatives to improve profits and cash, to learn how to drive 7 key levers. There's only 7 key levers that management can control that can impact profitability and cash. And I'm going to teach those to you today. You're going to learn how to create a simple profit and cash scoreboard that will align and inspire the team. And then most importantly, I'm going to give you some practical ideas that you can go implement immediately to make an improvement in the profitability and the cash flow of your organization. So let's get started. So to kick it off, I asked you to take a look at a case study and analyze this company, Mylock. Now, they are a distributor of hair care products. And I asked you to analyze their business. And the fundamental questions that I wanted you to answer is, on a scale of 1 to 10, how would you rate Mylock's financial performance? 10 being rock solid, 1 being a mess. Where does Mylock fit? And then I asked you to compute a number. How much cash is Mylock generating? So what is their net cash flow for the year 2019 in the financial reports? And then the third question is, where would you focus management efforts moving forward? In other words, where do you see an opportunity to make an improvement? And so we're going to walk through and answer those questions for you today. So let's take a look at their financial statements. And you can see on the left that, you know, their revenues are growing. They went from 21.5 to 24.5. You can see their gross margins went from 7,800 to 9,000. All good news. Their net profit before tax is up, as well as their bottom line profitability, which they generated $1.5 million in net profits in the year 2019. Now, if you look at their balance sheet, you'll see that cash has stayed the same at their bank accounts, but their receivables are up, inventories are up, fixed assets have stayed the same. Their accounts payables are up. Bank loans are actually down. That's a good thing. You see their equity went from 2,500 or 2.5 million to 4 million. So you ask yourself, what is the financial picture of Mylock? And a lot of people look at this and probably rate them a 9 or a 10. And I'm going to challenge that Mylock's story is not quite that strong. Let's dig further. Notice that net cash flow, which is the most important measure of a company. You know, you can't spend this money here. You can't spend even this $1.5 million. All you can spend is the cash that you generated. And it's that cash that allows you to invest in new machinery, allows you to invest in new equipment, allows you to invest in new A players to help you scale. So cash is the fundamental throttle or the fundamental constraint that dictates how fast your company can grow. An inability to generate cash, and you're going to have to grow at a very slow rate. You can generate a lot of cash, and you can really put the pedal to the metal and grow at a much faster rate. So notice that Mylock's cash flow is the change in deposits plus the change in debt. So let's look at the cash they generated. So notice that their cash balances stayed flat. They really didn't move any money that's sitting in their bank account. Didn't grow, didn't increase. But look at debt. Their debt went from 4.1 million down to 3.8. So that's good news, isn't it? And there's a $300,000 difference. And notice they did not take on any long-term debt. Again, good news. So what this tells us is at the end of the day, MyLock generated $300,000 in positive net cash flow. And $300,000 is better than zero, or it's better than losing or consuming cash. But it begs this question. MyLock generated $300,000 in net cash flow, but where did the rest of the 1.2 million in net profit go? They generated $1.5 million in net profit, but only 300 in cash. Where did the other 1.2 million go? And that's the question that leadership is often asking. Why aren't we generating more cash? And if we generate more cash, that strengthens our financial position. So to take MyLock from maybe a 5 or a 6 that you rated it now, or that I might rate it, up to a 9 or a 10, we got to figure out how to close the gap on that 1.2 million to that 300,000. And this is a common scenario that I see amongst the clients that I coach. So let's dig a little bit deeper into the balance sheet and see if we can answer that question. So notice here that accounts receivable went from 4 million to 5 million. Well, there's $1 million in cash right there in accounts receivable. And notice that inventory or work in progress went from 2.5 to 3.2 million. So there's another 700,000 in cash that was consumed by the business. And then notice payables went from 300 to 3 million to 3.5 million. Now that is actually good for cash flow, because that means our vendors, our partners, are helping to fund some of our growth. So that actually helps our cash flow, assuming we're not damaging our relationships with those partners. So the net of all of that is the 1.2 million in cash that was lost from the 1.5 in operating income to the 300,000 in net cash flow. 1.2 were consumed amongst receivables, inventory, and payables. We lumped those together in a category called working capital. And just think, who in your organization has the biggest influence over working capital? Well, it's your management team. So this webinar is about how you can get control over that working capital. So with all this said, on a scale of 1 to 10, how would you rate MyLock's performance? Well, maybe now instead of an 8 or a 9, now maybe you're taking it down to a 5 or a 6. What is MyLock's cash flow? 300,000. Where would you focus management efforts moving forward? It's on better managing working capital. All things remain the same. Let's get that working capital number down, and then we're generating more cash that we can invest in the business. You might be asking yourself, Mark, how do we do that? And you're in the right spot. I'm going to show you how. So before I do, I want to introduce one more term, and it's called the cash conversion cycle. And the cash conversion cycle is made up of accounts receivable days. Now, I showed you accounts receivable in terms of dollars. I'm going to convert it to days here in a minute. And this is something that's easy for a financial executive, or really any manager can easily do the calculation to convert it to days. But it's accounts receivable days plus inventory days minus payable days, compute your cash conversion cycle. So if we look at MyLock, they had 76 days of accounts receivable, 78 days of inventory, and 85 days of payables. So their cash conversion cycle is a 69. Now, the reason I like days so much is it normalizes for revenue growth, because clearly your receivables are going to grow as the company grows, or that's conventional wisdom. And that's why oftentimes it doesn't get the attention it deserves, because it's assumed it's going to go up with revenues. But by converting it to days, we can better create benchmarks and hold ourselves accountable to keeping our days at those benchmarks. And I'm going to explain this a little bit more in a minute. But first, I want to tell you about Dell Computer, based down in Austin, Texas. Many of you on the call here obviously know Dell. But in the early 90s, Dell had a cash position a lot like Mylox. If you look at their cash conversion cycle in 91, it was a 63. And so that inability to generate cash was a constraint on Dell's ability to scale. And so Michael Dell went out and he brought a finance team in, a guy named Tom Meredith as a CFO, and they started focusing on the tools that I'm going to show you in today's webinar. And they took that cash conversion cycle from a 63 down to a 21. So what does that mean? What that means is in 91, Dell had 63 days from the time they sold something, or they had 63 days worth of investment until they received the money from their customer on the products and services that they sold. With a negative 21-day cash conversion cycle, that means they literally had their customers' cash 21 days before they had to invest a nickel. Said another way, the more Dell sold, the more cash it generated to fuel its growth. And the rest is history. Dell is a multi-billion-dollar company. Michael Dell has become a billionaire, one of the wealthiest people in the world, because in big part because of their ability to solve this cash flow issue. So I'm going to teach you how to do that today. And I'm going to teach you using one of our tools called the Power of One. And the Power of One focuses on what management has the most influence over, these 7 levers. So I'm going to start with the profit and loss statement. And this is Mylox here. And you have one that undoubtedly looks similar. But at the top line, we have revenue. And remember what I said earlier, revenue is vanity, but it's important to pay attention to. And the 2 drivers of revenue are price and volume. In other words, if I wanted 5% more revenue, assuming I could keep volume the same, I could just pass on a 5% price increase, and that would increase revenue by 5%. I could also sell or generate 5% more volume or more sales, and that would also give me the 5% increase. Now, most companies are looking for a combination of the 2. How do we maintain pricing power while also growing sales? So those are the 2 levers that guess who has the most control over that? Management team, right? We have absolute control over price and volume. Then we've got gross profit. And gross profit is the difference between what we sell a product for and then our direct cost of delivering it. In most companies, that's some purchase material, maybe that you buy and resell, or maybe it's some labor that you apply. We call that direct labor. So gross profit is made up of the difference between price and our cost of goods sold, that's made up of product that we purchase as well as direct labor. And then operating profit. And operating profit is the difference between gross profits and then our overheads. And everybody on the call here today is probably in the overhead bucket in their company. And guess who controls or who has the most influence over overheads? Right, it's the management team. And so what we want to do is focus on the management team on the big 4 drivers of these, which are the first 4 in our Power of One. It's controlling price, it's controlling volume, controlling cost of goods sold, and controlling overheads. That leads to profitability. But remember, from Mylox's case, profits were good. So how do we impact the balance sheet? And that comes from accounts receivable, that comes from inventory, and that comes from accounts payables. Now, before I move into the tool, let me ask you a question. Does price or volume have the biggest impact on operating profits and cash flows? So if you go back to my example, if I wanted 5% more revenue, and if we were assured that volumes were going to remain the same, and I said you can get it by passing on a 5% price increase, or you can get it by increasing volume by 5% at the same price, which would be better? Which would ultimately be better for profitability and cash flow in your organization? And I'll tell you, when I ask this question in a seminar format, I'll get about 50-50 on price and volume. And I'm going to answer that question in a minute, looking at Mylox financials. And then I want you to think, what might that impact be at my company? So I'm going to take you to a tool, and this is included in the handouts for today, but it's called the Power of One. And this tool is a powerful way to align your management team on those 7 variables, those 7 levers that your management team can absolutely control. And it answers the question, how would cash flow and profitability be impacted if you increased them by 1%, small 1% change, or 1 day? And the second question it answers is, which of these variables most influences profitability and cash flow? And to demonstrate this tool, I'm going to take you online to an online tool I use called the Cash Flow Story. And this tool uses the Power of One. They were the inventors of this concept. And I'm going to walk you through the tool. I make this tool available to all my coaching clients to help them understand how cash flow works in their company, and to help them understand where the biggest drivers are of profitability. So let me take you to this tool now. And here's the tool. And you'll see I've got it set up for MyLock. So here's our 300,000 in net cash flow that we talked about earlier. And what I've done is I've applied a 1% driver to the first 4 drivers, which again go back to your income statement. They were price, volume, cost of goods sold, as well as overheads, and then a 1-day improvement to accounts receivable, inventory, and accounts payables. And what you'll see over here in the right column is you'll see what is the impact on cash flow and what is the impact on operating profit of these 7 levers. And as you look through them, one thing that should jump out at you right off the bat is the biggest lever is price increases. If we can maintain or push across price increases, that has by far the biggest impact on cash flow and profitability. And let me make the argument another way. A lot of times what I'll hear from a sales team is, hey, we're going to discount, but we're going to make it up on volume. And watch what happens over here. If we were going to pass along, let's just say a 3% discount. Look at the impact this has on cash flow. Look at the impact this has on operating profit. And you say, yeah, but Mark, we're going to make it up on volume. Okay, how much volume do we need? Do we need to equal? Will a 3% increase in volume make it up? It won't. What about a 5? What about a 6? What about a 7? We're still short of making up the profitability. What about an 8? It would take an 8% increase in volume to make up for a 3% discount in price. But don't just look. Remember, revenue is vanity, profit and sanity is sanity, cash is king. Look at the impact on cash at MyLock. They would lose $570,000 with a 3% discount in annualized cash flow. 8% only makes up 344% of it. They would need 9, 10, 11, 12, 13, close to 14% in additional volume to make up for a 3% discount. That's like a 1-to-4 variable there, a 1-to-4 ratio in terms of price to cash flow. So my point, when I show this to my clients, it's a game changer because they never realized the impact that pricing was having on their profitability and on their cash flow. But let's get back to MyLock for a minute. If we wanted to improve MyLock's cash flow, of course, I'd like to say, could we pass along maybe a 1 or a 2% increase in pricing? And typically, a 1 to 2% price increase is not even noticed by customers. Maybe they have more, but let's just use 2. And let's assume that volume is going to stay the same. Let's assume that cost of goods sold is going to stay the same. And let's assume we're not going to do anything on overheads. And we're going to focus on pricing, and then we're going to work on the balance sheet. Now, if you look at accounts receivable days and you say, where should that number be? I'm going to take you to a section here, and I'm going to show you historically how MyLock has performed. And you'll notice the software has computed their accounts payable, their inventory, and their accounts receivable days for the last 3 years based on loading their financial statements. And notice that last year they were at 68 days. Today they're at 76. That's a 9-day delta. So what if we could go back and just say, hey, team, let's just get back to where we were last year? Would that be a realistic goal? And I think most management teams would say yes. Let's look at inventory days. Inventory days has gone from 67 to 78. That's an 11-day difference. Again, same question. Team, can we set a goal this year to get back to where we were last year, managing our inventory in a way that's similar to the way we did last year? I think most management teams could buy into that goal. And then accounts payables at 85, it's gone from 80 to 85. Let's just leave that where it is. So I'm going to go back to my Power of One tool now. And I'm going to say, let's take receivables and let's get our 9 days back here. Let's reduce that by 9 days. And look at the impact. That's almost 600,000 in cash flow right there. Let's take our inventory days and let's take our inventory and let's get that back where we were the year before. That gets us to 11 days. That gets us, there's another almost $500,000 in cash flow there. So remember, before implementing the Power of One, we were generating 300,000 in cash flow. If we could pass along a 2% price increase and get accounts receivable and inventory back to where they were the previous year, we add another 1.4 million in cash flow, which takes our net to 1.7 million. Remember, we were generating 1.5 million in bottom line profitability. Now we're generating 1.7 million in positive cash flow, and we're setting ourselves up to be in a much healthier financial position to scale the company. So again, you may be saying, okay, Mark, this looks good. I'm sold. I'm bought in. How do we make the improvements? And let me tell you that the first thing to do is to raise the awareness. Again, just getting your management team to understand the impact of these decisions is the first step in making change. It's the first step in driving changes in behavior. And filling the Power of One out for your organization is a big step in that process. But there's some other things you can do. So let's start with pricing. Good, better, best pricing is a great strategy to help your sales team and help your marketing team drive up your average selling price and drive up your gross profit per sale. And I love this Harvard Business Review article. It's a great primer on the topic. So highly encourage you, snap a picture of this slide and go download this from Harvard Business Review. Great place to start. Second thing is start to identify profit pools. So I talk to my clients a lot about this idea that Vern's developed. It's the idea of the 770 rule. So where's like a 7% niche where we can control 70% of the profits? If you look back on Apple, if you look back on IKEA, if you look back on Southwest Airlines, in their scaling days, they controlled less than 10% of the market share, but yet controlled more than 70% of the profits in that niche that they own. The riches are in the niches. And oftentimes my clients have a segment of their customer base that's not profitable. So let's get rid of the clients that are not profitable, and let's get our sales force laser beam focused on where the most profit is for your organization. Where are those profit pools? Of course, minimize discounting. As I showed in the demonstration, huge impact on your profitability and cash flow. And then look at marketing and sales execution. Focus more on selling value. And then build a sales playbook so that you can start to optimize the sales plan. Gross profits, look at where you can improve purchasing. Look at where you can increase the utilization of direct labor. If you're doing any kind of construction or services or anywhere where you send technicians out in the field, I can just guarantee you there's a big opportunity here to better manage your direct labor, reduce mistakes, manage your change orders, do more effective planning where you're hitting closer to actual to budget. I've got a client right now that's set a metric around that, and they're bending the curve on their profitability by focusing on actual costs to what their engineered costs are and working with management to close that gap. What are the things that are causing us to miss? Let's fix it. Let's close the gap and increase the profitability and cash flow of the organization. Reducing overheads, again, look at marketing, look at sales, look at management, look for recurring charges that aren't adding value to the organization anymore, and look for the big lines in your profit and loss. Like I was with a client last week, shipping costs are a big item. They're a big overhead cost. Put somebody on shipping costs and let them manage it and start working to reduce that expense as a percentage of revenue and drive that expense down to increase the profitability of your organization. I conducted a webinar here a few months ago. You can find the replay on my site called Self-Directed Teams, the secret to increased engagement. The idea is, how can we get teams to more self-direct and reduce, minimize, and not eliminate the need for middle management, right? Let's look at where can we focus on taking costs out from a management perspective and an overhead perspective to help increase the profitability and overheads so you can scale, so you can make a bigger impact through your mission. Again, we've got a tool called the Cash Acceleration Strategies tool, and I included this in your packet, but you'll see it identifies the 4 areas in your business, your sales cycle, your production cycle, your delivery cycle, as well as your billing and payment cycle, and gives you a way to brainstorm ideas to take costs out of each of those. And we give you some categories to look for. Where can we eliminate mistakes? Where can we shorten cycle times? And where can we improve our business model? Do things different that generates cash. Think back at Costco when they came out with the idea of a warehouse club. That was unthought of back then. Today, that club, the money they make off the membership covers all their profits. What that means is they run those warehouses at near break even, and it's all the cash that's generated, which is all up front, by the way, that's generated off of those membership fees that funds all the profitability for the company. So where are there opportunities for you? And I'm going to take you through and I'm going to brainstorm some ideas. And I would encourage you to have this sheet in front of you and write these down as I'm making my way through. Where could you improve the profitability and the cash in your organization? Which of these would apply? So let's start with sales. And it really starts with your strategy. And is your strategy around building your brand? Are you focused in the niches? Do you have an ideal target market? Brand is your reputation. It gives you pricing power. Are you measuring and optimizing your sales cycle? Do you have a playbook that you continue to refine and look for ways to be more efficient, more effective, drive higher gross profit sales in your organization? Is your team empowered? Can they make pricing decisions within constraints that you've offered? Can they negotiate delivery and modifications in the field, or does it have to come back to the office? And again, go through approval loops that can be time consuming to getting business closed and products delivered. Can you implement a risk reversal strategy? So remove the risk from your prospects of engaging with you by offering money back guarantees or other strategies. Is your booking process, are there errors in there that are causing you to have to redo, reship, or delaying billing? Can you pass pricing increases on? Can you ask for down payments? This down payment has been a big driver for a lot of my clients this year. Do you pay commissions on revenue or do you pay on gross profit? If I'm paid on revenue and I pass along a 2% price increase, I take a 2% hit on my commissions, which is not a very big hit in the grand scheme of things. However, if you sell a product that's got a 40% gross margin, and now I'm offering a 2% increase or 2% discount, That 2% is now a much bigger piece of the pie. Now you're up 5, 6, 7, 8% of my commission is being hit. I'm going to work a lot harder to maintain that pricing with that client. What about in the production area? Can you implement lean? Better, faster, cheaper, empower everybody around the ideas of looking for just small incremental improvements to drive waste out of your cycle. Can you improve forecasting? So you've only got the inventory and the labor that you need to meet the demand. Can you work with your vendor to improve their terms? Maybe direct ship. Maybe they give you an ability to not pay for inventory that you haven't delivered yet. Can you reduce that inventory? Maybe just in time, get inventory where it's showing up just in time. Can you improve quality? Is there an opportunity to implement a recurring revenue model that would help you have more consistent cash flow in the business? Take a minute and write down what you think you could do in your business. Let's talk about delivery. Can you ship faster? Can you confirm the shipping instructions so that we reduce errors? Can you pre-purchase product? Can you find alternative shipping methods? I was with a client last week that's going to implement, a strategy. They're doing the analysis to say, should we own 1 or 2 trucks of our own? Look at what Amazon has done in terms of today. Instead of relying on third parties, they control a big chunk of the shipments that they send out. Are there ways that you can find alternatives that can drive your costs down? What about in terms of billing and payments? Can you invoice faster? It's amazing to me the gap between when the work's done and when the invoices come out. And that day gap in there can be reduced. And I bet if you went and looked, a lot of you on the phone today are going to find that you got 5, 6, 7, 8, maybe more days from the time the work's done till we get the invoice out. Can you bill projects bi-weekly? One of my clients in Austin, they're a consulting firm. They went and talked to their clients and they were fine with it today. Instead of invoicing monthly, they're invoicing every other week to increase cash flow. Can you get bigger deposits, more money up front? Can you call the client right when you invoice to make sure they got it and get a commitment on when it will be paid? Can you implement ACH and credit cards? Can you improve the accuracy? How many of your invoices are coming back? It's time to collect, but there's an error and now you got to redo the invoice or it delays collecting. Can you add a pay now button on your invoices? With a lot of the online billing now, you can send an invoice out with a pay now. And I've got clients that are implementing this and seeing a big drop in the days because people just hit the pay now. It's easier, it's more efficient, and they just pay it right on the spot. So what are strategies that you can implement that will help increase the cash flow in your organization? Take a minute and jot down in the notes what could be applicable to you. All right, I want to wrap up by giving you an idea for a scoreboard. And this is MyLock's scoreboard, and it's for the fiscal year 2020. And notice what they've got on their scoreboard. It starts with gross profit. It does not start with revenue. It starts with gross profit. And you can see here, they had a green target. That's their target of $10,350,000 for the year. They had a stretch goal we call super green of 10.8. And if you're below 9.9 million for the year, it's red. That's an absolute minimum expectation for MyLock. Well, you see their actual came in at 10.5, so that was green. You see the second item they track is gross margin. So they want to track that percentage. So they're tracking the dollars here and the percentage here. You see, and that came in super green, by the way. So big focus, increase to a super green. Now overheads, they didn't make as big a jump here. The target was 6.7 million. They came in at 6.85. They were between green and red. So they scored themselves a yellow on that. EBIT, their operating income, their target was 10%. They came at 9, came in just a little bit short there, but clearly a good trend up here with these gross margins. Area of opportunity, continue to work on these overheads. And then look at their working capital days. Their target here was receivables to take that to 68, inventory to 67, payables at 89. for a cash conversion cycle of 46. They hit the receivable number, missed slightly on inventory, delivered on the payables, and just missed slightly on the cash conversion cycle. So super easy way for the management team to see our efforts bearing fruit, right? Is it making a difference in the financial metrics that matter most to the organization? So let me leave you with some final thoughts as you think about how can we increase cash flow and profitability so we can scale faster, so we can make a bigger impact. Number one, stop saying this is just the way it is in our industry, right? Challenge the status quo. Be the leader that drives the change in your industry. If you want to be paid sooner, just ask. Just ask. It's been really, really exciting to see how many of my clients thought, well, this is just the way it is. We deal with these big companies. This is just how they are. But by simply asking, they're getting paid faster and generating more cash to fuel their growth. Give value back to your customers who pay on time or pay in advance, right? Add more value to those clients. Get your invoices out quicker. Hire somebody in accounting. You know, maybe it makes sense to put somebody on that job, or that every Monday, somebody's job is to go through and call and make sure all the invoices got, or when we send our bills, it's somebody's job for the next 3 hours to go through and call everybody, or our high risk clients, or our typical slow pay clients, and make sure they got the invoice, make sure it's accurate, and get a commitment on when they're going to pay. Send friendly reminders 5 days out. You know, if invoices are recurring, obtain a credit card or ACH. You know, understand why your clients are paying late. You know, is it something you're doing that's an easy fix that can help drive more cash to the business? Understand each client's payment cycles and time your billings to coincide, to match up with when they get paid. Help your customers improve their cash flow so they got more cash to pay you. Offer a product or service. This is my favorite one. Offer a product or service so valuable that you have leverage. You know, we pay, you know, Apple their prices if you're an Apple fan because you want Apple. Think of the providers that you pay because you want to be on good relationships with them. Why not ensure that you're on that side of it with your customers? Remember, improving margins and improving profit improves cash. So as a recap, aligning operational initiatives to improved financial results will make an impact. All profit and working capital improvements come through one of the 7 levers. If you're having a problem with your finances and you want more cash and more profitability, it lies in one of these 7 levers. So let's go back to my question with Mylock. Where would you focus management's attention? It's on these 7 levers. And then finally, a simple profit and cash scoreboard will inspire your team to win. Now, I want to thank you for attending today's webinar. To receive a copy of the slides, complete the post-course evaluation. In that evaluation is a question: would you like to have the Power of One run on your organization? I'm happy to do that for you. I can send your analysis and you can see where your buckets are, and you can take that to your team and use that to help get their attention on where our profits are, where opportunities are to really make an impact on cash flow. And so I'm happy to do that for you. And then our next webinar is strategic planning, finding your X factor. It'll be in December. Get yourself registered for that, and I'll open it up for questions.